All right, thanks for joining me. We're going to talk about Forex, and I hope you're really excited about this because I sure am. Foreign currency, which is what we're going to be talking about, is a great way to get started in trading. And if you're not investing in anything, totally recommend that you at least look at Forex. And I'm glad that you have decided to get this information from me because this is a great way to get started. Okay, now there is a lot to learn. I will forewarn you, we've got a lot of stuff to cover. I'm just going to be getting you, through the basics. The foreign currency exchange, or FX market, or just FX, involves the fluctuation of currencies. That's the only way that we can trade currencies, is if we compare one currency to that of another. And the thing is, those values change a lot. Today, the U.S. dollar might be worth a certain value compared to the Canadian dollar. In 2 hours, that could be totally different. There could be quite a bit of a difference. So those fluctuations occur literally minute by minute. Traders, which is what you're studying to be right now, speculate on those changes. And speculate is just a good way to say guess. It means that by analyzing information, you're able to make an educated guess on what you think the market is going to do. So, for example, if you believe that the U.S. dollar and the Canadian dollar, that there's going to be a change, you would either buy or sell one of those currencies. And then when that change occurs, then you would do the opposite. So you might buy the dollar, and then when the dollar raises, you would then sell the dollar and you would make a profit. So money is made by buying and selling the different currencies at different times. Let me give you an illustration. Let's say I was going to go over to the UK. Okay, so I go to my bank, or better yet, I'm in the airport, and I say, hey, I want to exchange this $1,000 in U.S. dollars for, a euros, because I'm going to be going over there and spending a good amount of time. Maybe I'm going to be there a month, maybe. And the teller there is going to give me a certain amount of euros back, right? Let's, the value just depends on whatever it happens to be that day at that given time. But let's say that when I get over to the UK, I find that pretty much everything that I need takes my credit card. So I just buy stuff with my credit card and I keep those euros in my pocket. I'm there a month and then I come back and I'm at the airport again and I'm like, hey, I want to exchange these euros for dollars. Now, during that month that I was gone, let's say that the dollar went down, it changed. Now the euros that I have are worth much more than they were before. So instead of giving me $1,000 back, she gives me $1,100 back. And I'm like, whoa, I made $100. That's the kind of thing that we're doing, except we do it on a day-by-day basis. There is over $4 trillion traded on the Forex market every single day. It is the hugest market by far, outweighing all other markets combined. Stocks, bonds, futures, everything. Let's take a look at some common FX terms. You have your account. This is just basically a record of all the transactions, buying and selling different currencies, adding money to your account, or withdrawing money and putting it into your bank account. An agent is a person that's used to carry out transactions for you. You could tell your agent, when a currency gets to this certain amount, I'm going to be out of town. When it gets to this certain amount, go ahead and buy this size, this amount of currency for me. Back testing. Designing a strategy based on historical data. What back testing allows us to do is test our strategy on what happened in the past so that we can tell what our system or our strategy would have done or told us to do at that given time. That way we can try to use it today and hopefully it works well today as well. The bid, this is the price an investor is willing to pay for an asset. So if I'm going to buy a currency, that's the bid price. The bid-ask spread is the difference between the bid and the ask price. A bull market. This is a market where the prices are rising, or they are at least expected to. And that is opposed to a bear market where things are going down. A central bank. This is a banking organization that is responsible for implementing a country's monetary policy. The central bank is a big deal. They're going to be like the bank that's in charge of everything for that country. Commission. This is a fee charged by your agent or broker. And in FX, really, it's not really a regular commission. When you buy or sell, it's going to be included in the price that's in there. There is what's called a bid-ask spread. And basically, when you make the transaction, it's all included in there, so you don't have to factor it in later or, be concerned with it. It's going to be right there. A day trader. This is someone who's entering and closing trades all in the same day. So as opposed to just buying stocks and you sit on it for a couple of years, you're going to buy or sell a currency, and later on that day, you're going to then sell or buy back, whatever. The Federal Reserve, also known as Fed. This is the central bank for the United States. Liquidity is the ability of a market to accept large transactions with minimal impact on price. And due to speculation, which is something we'll learn about in tomorrow's video, the liquidity of the FX market is phenomenal. It just doesn't, you couldn't buy enough currency to cause problems. The long position. This is where you decide you've got securities or currencies, and you're not intending to sell them due to speculation. You're going to be holding on to them for a while. The margin. This is the percentage that a trader is going to have to deposit as collateral. We will talk a little bit more about margins tomorrow, but just to get you started here, whenever you open a trading account, you're going to have a certain amount of money, whether it's $100 or $500 or $1,000 in that trading account. You don't trade with just that money. The broker that you're using actually allows you to trade on a margin. You use some of your money as that collateral, and then a percentage of their money is used to purchase the currencies. Now, what that gives you is a huge amount of buying power. Consequently, it also leaves you open to a huge loss, so you have to be pretty careful with that. But trading on margin is a great way to accumulate funds in large amounts. Open position. When you have an open position, that means that you have put yourself into a trade and you're still vulnerable to any rate changes. If anything happens during that time, it's going to affect you. So you've not closed your position yet. A pip is the smallest amount of movement for a currency, typically 0.0001. Some currencies are a little bit different than that, but most of them, you're looking at 0.0001. The spread, this is the difference between the bid and the offer price. And then volatility, the tendency to fluctuate over time. If something is highly volatile, then it's going to fluctuate quite a bit. That means the currency prices are going to change a lot. Okay, now, there are a lot more terms. This is just a basic thing to get you started, some terms to familiarize you with the industry. Tomorrow, we're going to talk a little bit more about how trading FX works. If you don't want to learn all this stuff, you don't actually have to. I recommend that you go through the course and learn the basics just so you know what's going on. But you can actually have a robot trade for you automatically, already tested, doing all that stuff. Just click the link to the right to get started with that. Otherwise, I will see you tomorrow in your next video.